Hi, folks. Good evening. Sorry for the slight delay. Welcome to Library Mistakes. Tonight we have a real honor and pleasure to have Russell Napier with us, the godfather of the Library Mistakes project. Well, the fearless leader of the Library Mistakes project, author, professor, macro strategist. He will be giving us a talk on 21 lessons from financial history for how we live today, which should be super, super interesting. For those who'll be watching this on YouTube later, please visit our site at www.lomlausanne.ch, where there's lots of other wonderful and super interesting presentations. So without further ado, Russell.
Boris, thank you. I think I'm mic'd up already, so
that's right.
I'm good.
That's right, yeah, sorry.
Welcome, everybody. Welcome to Lausanne. If you're watching on video, get yourself to Lausanne. You don't know what you're missing at Library Mistakes Lausanne. I like the term fearless leader. It feels, and I'm sure you feel this as well, it feels a bit like being in the wilderness, Boris, doesn't it? Wandering around talking about financial history, but no longer. Not anymore. The world has just changed. And the world has changed because of a man called Angus Deaton. I don't know how many of you know Angus Deaton. He's a Nobel laureate in economics. And he has made an incredible interview article released through the IMF. And I wanted to read you just one bit of it. This is just one bit of it. There are lots of incredible bits in his article, but I wanted to read you this bit. And he says this on empirical methods. And this man's got a Nobel Prize in economics. The credibility revolution in econometrics was an understandable reaction to the identification of causal mechanisms by assertion, often controversial and sometimes incredible. But the current approved methods, randomized controlled trials, differences in differences, or regression discontinuity designs, have the effect of focusing attention on local effects and away from potentially important but slow-acting mechanisms that operate with long and variable lags. Historians, that's you, who understand about contingency and about multiple and multi-directional causality, often do a better job than economists of identifying important mechanisms that are plausible, interesting, and worth thinking about, even if they do not meet the inferential standards of contemporary applied economics. So this is now our manifesto. It's endorsed by a Nobel laureate. There is something in financial history that can tell you something about the future. Remember, the reason that it was rejected for so long is that the efficient markets hypothesis states that all available information is in the price. And what better definition is there of history than all available information? But now we have a Nobel laureate who can say that a historian working really only from all available information has something to say about mechanisms, causality, and the future for financial markets. Now, the role of financial history in forecasting a business cycle may be really somewhat limited, actually. Business cycles are difficult things. I've lived through many of them. But the way we live now, which is the name of this lecture, has really got nothing to do with a business cycle. We're living through a profound structural change in the way the world works. And that's important because I think the role of financial history is now much bigger. Because what we have to do is try and work out how the structure of the system is changing, what the consequences of the old structure were, what it leaves behind, particularly in terms of imbalances, and crucially, what the new structure will be. And those are the questions we need to ask, and those are the questions that aren't being asked on the whole by economists, because it's much easier to stick to the old rules. Look, we're all like that. We all stick to the old rules. When you get to a turning point in history, when there's to be a structural change, how many of us can make the leap, particularly if you're a professional investor? How on earth can you make that leap to a more radical asset allocation at a time when all the competition is playing by the old rules? But I think that's what financial history tells us. When you come to that structural change, you have to make a big leap. And that's what I'm going to talk about tonight. But not a big leap in owning risky assets. You don't have to own risky assets. If you go back to the late 1960s, if you wanted to preserve your own wealth and preserve the wealth of your clients, you didn't have to own particularly risky assets. You had to own gold, maybe commodity stocks. You certainly didn't want to own bonds. and value stocks. These are the things you want to do. None of them per se, in and of themselves, would be considered risky, but you had to own them in incredibly risky quantities. And that was the risk you were taking because everybody else was running a balanced portfolio. So I'm suggesting to you that you can preserve your wealth in this environment. There are things to buy. They're not inherently risky. But compared to the quantities that all your friends will own, everybody you have dinner with every night, every time you go out and you tell them what you own, they'll go, my goodness, that's very risky. So let's talk about these profound changes in terms of the light of where we are now. The way we live now, by the way, you probably know, is taken from a novel by Anthony Trollope about a great railway fraudster in the middle of the 19th century, hence the name of the title. My first lesson, and I've been doing this for quite some time now, I do it at universities as well, is spend as much time analysing supply as you spend analysing demand. Now that's a general rule that pervades all the time, but it is really important today because of China. But why is it important all the time? Well, I've been in this business now since 1989. And believe me, people get very excited about demand because it's really quite interesting, isn't it? You know, how many more iPhones can be sold? What is the demand for the products of ChatGPT? That's really quite interesting. And also, you can kind of fudge the number. You can kind of look at GDP growth, add a little bit here, take away a little bit there. You can sit in a room and try and come up with some numbers. But supply is really tricky. I mean, what is the future for anybody know what the future for global cement supply is? Well, to do that, you'd have to be out looking at who's building new cement capacity, where they're building it, how far they can transport it without ruining the economics, etc., etc. And most people just can't be bothered. Supply rises from the dirt and demand shines in the stars. So you've got, if you're analysing anything, to say, okay, I get the supply side, look at the broker's report, I guarantee it'll be 90% about demand. And then say, what's this guy written on supply? And if he hasn't written anything on supply, don't read the report. Find somebody who can contemplate, read, understand, and talk about supply. Now, that's a general rule. Why is it important today? Well, it's China. If we were, and I think we will, you'll have your own opinion, but if we were to sever our ties with China, or China was to sever our ties with us, this would be the biggest supply shock in global history. Now, we've had some supply shocks. Obviously, world wars are pretty big supply shocks. But I think in many ways, this one would be bigger. Given this relationship we've had with China now really since 1994, and the massive amount of investment that China's done over that long period. And by the way, that was the big surprise. One surprise was that China grew so fast, but actually the biggest surprise was just how quickly they increased supply. Supply not just to satisfy domestic demand, but to satisfy global demand. And what happens in a world where we did not trade with China and do not trade with China? Well, there's a profound shock in terms of global supply chains, prices, and there'll never have been anything like it in human history. So we're looking at China, we're talking about this geopolitical fracture, but not really coming to the cusp of what that means, which is a huge supply side shock. Now, that might mean terrible things for some parts of portfolios. May not be good for bonds if it spikes up general inflation and all the stuff we don't buy from China. Could be very good for the steel industry outside of China. The Chinese overproduction has destroyed returns on many industries. And if we find ourselves in a position where there was a fracture between China and the rest of the world, many of these old industries, often called sunset industries, could be on a comeback. Shipbuilding, all the stuff that nobody has in their portfolio, well, somebody must have in their portfolio. If you think that's all pie in the sky, then you might want to wonder why the share price of Mitsubishi Heavy Industries is up 150% year on year. Something is changing. Something's happening in the markets that's telling us something. We are dazzled by AI, and I'll not have anything to say about AI, but there are other things happening out there that we're ignoring. So when we invest in anything, try to spend time looking at supply. I think if we do that today, where we end up is we end up being concerned about the relationship with China and looking at all sorts of industries which look cheap. We have the expert on value here, but they certainly look cheap to me, under-owned, under-loved, but they wouldn't be in such a perilous condition if we were not trading with China. Number two is there is no relationship between GDP growth and the return from equities. Now, Boris introduced me as a global macro strategist. I'm now redundant having said that because you would think that that's why people talk to top-down macro people. And it is. There's a lot of people in the markets who spend a lot of time talking about GDP growth. It's not really relevant. There are things that happen in the macro economy that are definitely relevant for stock markets, but not really GDP growth. It doesn't really matter that much. How do we know that? Well, we have some really wonderful data now from Dimson, Marsh and Staunton of quite a lot of stock markets, all beginning in 1900. So we'll now run the whole way to the end of 2023. So we've got 123 years of data. And if you plot those against GDP growth, there's no relationship. It's just not there. And that's quite a long time, 123 years. Why? Well, I think it's probably because there are lots of reasons, but probably because of what Warren Buffett famously said. He said, price is what you pay, value is what you get. And it's possible to so overpay for an asset that it takes a very, very, very long time to make any money. So Japan famously has now crept above its peak for 1989. Well, the economy grew. I mean, it may not have been wonderful growth, but the economy grew, but the stock market's only just got back because you overpaid for it. I was in Asia during the Asian economic crisis. There are quite a few markets in Asia which are just very close to where they were at their peak in 1994. But the economies have grown quite well. A big bust in 98, but they've grown quite well. So it really is important, the valuation you pay, and it's not just about GDP growth. So that's taking me back to the stock market. The US stock market, by any measure of its historical valuation, the one that we use, and I run a course in finance associated with a charity that runs the Library of Mistakes, and the one we look is at the thing called the cyclically adjusted PE or the Shiller PE. You can also look at the Q ratio. By any measure, it's expensive, but there are also lots of cheap stock markets in the world. So there is an opportunity. If ultimately what drives return is valuation, then there are things to buy. There are people who think there's an everything bubble. Interest rates were so low that everything went into a bubble. But when you look around the world today, and if you're a value investor, actually there's a lot of things that look pretty reasonably priced. So don't get fixated on the growth of the United States of America, for instance. Look around the world, find cheap stocks, particularly if you think they're going to benefit from this change in relationship we're going to run with China. Number 3 is named after a man called Gordon Pepper, who used to teach on this course that I run. And Gordon entered the City of London in the early 1960s, so he has quite a lot of experience in bull markets and bear markets. And he was teaching one day for me when he suddenly, on his feet, invented Pepper's Law. He called it Pepper's Law, so I better call it Pepper's Law. I don't argue with Gordon. And here is Pepper's Law. When something is going up and looks like it's unsustainable, I think we can think of current examples of this. How do you work out when it's going to stop? Now, in my career, this is by far and away the most difficult thing to do. To quote from Alan Greenspan, when there's a rational exuberance, how do you know when it's going to stop? Well, Gordon Pepper had an idea. I think it's the most accurate I've yet come across, if not very accurate, still the most accurate. Use every analytical power that you have to assess when it's going to stop. Use everything you've learned to assess when it's going to stop, and then double that period and take off a month. And that's Pepper's Law, which is a little bit of sort of a faux precision around the famous quote from Lord Keynes, J.M. Keynes, who said that the market can remain irrational for much longer than you can remain solvent. So if we're looking, for instance, at what's going on in AI at the minute, there's some things that aren't there yet, really. Boris might contradict me, but I don't think we've got a huge flood of IPOs coming out yet. And usually these, great big surges pull forth the supply of securities, and that hasn't come yet. So probably it's going to run for a bit longer than you think it can run. But if that's the most precise that I can be from my 33 years of reading financial history, it's not very precise at all. That's the most difficult bit. When things are overvalued, working out when they turn and return to value is probably the most difficult thing. But you now have Pepper's Law to give you some guidance on that. Number 4, Charlie Munger. This is not just about investment. This is about life. And Charlie was he was the brains of the operation, as we all know. And he said, never ever think about anything else when you should be thinking about incentives. And anytime you're in a room with anybody, you really need to ask what the incentives are. They're often not what you think they are. And the whole of economics is based upon that we all have one incentive, which is to get richer. And actually, there's lots of people who aren't necessarily that incentivized. They might want to look better in the eyes of their colleagues. They might want to be aiming for the top job in the organization. Or they might want to be making lots of money. Or there may be other things, more altruistic things that drive them. But unless you discover what the incentive is, you can't forecast the outcome. That's what Munger said, and I think he's right. So why is this important for the way we live now? Well, there is one person in the world whose incentives matter for us and change everything, and his name is Xi Jinping. Xi Jinping controls a lot of things. He's in an economy which is somewhere between a command economy and a market economy, and he controls the banking system, he controls interest rates, he controls the exchange rate. These things are profoundly important for all of us. This is the second biggest economy in the world. And yet we know from financial history, from economics, that it really isn't possible to control everything. And at some stage you have to choose what you want to control. And that's particularly true when it comes to monetary policy. Can you control, at the same time, can you control the price of money, interest rates, the quantity of money, and the exchange rate? Well, no, you can't. I mean, not unless you run a completely closed communist-style economy. And yet, we know today that Xi Jinping would like to control all three of those. That's his incentive. His natural incentive is to control. Not possible. So now you've got to work out which one is he incentivized to let go. Because he is going to have to let something go, given where we've got to in his economy, which is inherently deflationary. Property prices are falling. There's a lot of commercial credit distress. What does he let go? So I'll now make a forecast and say it will be the exchange rate. Obviously, I don't know, because it's very difficult to forecast one man. You know, it's much easier to forecast 1 million people than one person. 1 million people acting together are somewhat predictable. One person is entirely unpredictable. So I don't know, but it really matters. So we need to spend more time thinking about Xi and thinking ultimately when it comes to the time to choose, what would he choose to control and not choose to control? Now, in my opinion, he will not choose to control the exchange rate. There's a long history of people who set out to control the exchange rate. When the time comes when they have to choose, it's the exchange rate they allow to float, because ultimately, no matter how embarrassing it might be that your exchange rate is going down, it's a lot less dangerous than not being able to control the price of money. So you'll be aware that in the United Kingdom in 1992, Lord Lamont was faced with the same problem. And I think he pondered that for about an afternoon. And after an afternoon changed his mind. And he made the right decision to not allow interest rates to be determined by the targeting of the exchange rate. And I think that comes from Xi. And then the whole world changes after that. The global monetary system that we have lived in now for 30 years really derives from that decision made by a different Chinese president in January 1994 to let the currency devalue and then not let it go back up again. And linking that Chinese currency at a time of exponential growth, mass mobilization of labor, mass mobilization of capital, that changed the world. It depressed inflation. It depressed US interest rates because they bought lots of treasuries. It encouraged gearing across the developed world, and it hollowed out manufacturing. That one decision, a political decision, not a monetary decision, not an economic decision, a political decision, changed the world. The world adapted to that. One of the things about finance is when there's a fixed point, the world adapts to the fixed point. The fixed point today is between the first and second largest economy in the world. The whole world is adapted to that. And if that's the thing that's going to change, then that's why we have a big structural change. You know, we all know there's a geopolitical change coming between China and the developed world. No one's really asking what does it mean for the monetary system? What does that mean for interest rates, inflation and asset prices? We're just saying, will China invade Taiwan? That's the only question that most fund managers seem to want to ask me about China. I don't know the answer to that, but there are more profound things. I mean, that's a big question. It's a terrible question to contemplate, but there are more profound things going on in this shift between China and the rest of the world. And it has impacts for property in Lausanne. It has impacts for bonds in America. There really isn't an asset price globally that isn't impacted in some way by this decision that will be made by Xi Jinping as to what his future currency arrangement is. Does it float? Is it a dirty float? Is it a peg? Is it a devaluation? This decision will be made by one man. Number 5. Important. Governments like markets only when they deliver the prices they want. Now, it's been possible, particularly in my career, to believe that the government made an intellectual choice, an ideological choice actually, many years ago, that markets are better at allocating resources than governments. And having made that ideological choice, let's say with the election of Margaret Thatcher or Ronald Reagan, and they said, oh, to hell with this. We're not very good at it. Let's let the markets do it. And you can certainly write a story that that's what happened. But then it did tend to deliver outcomes that they liked as politicians. It did tend for many, many years to deliver outcomes that got them re-elected. And you can see from looking around the world that that is not where we are today. And their decision to that is not to say, let the market work it out. Their decision is stop the market. And we obviously saw that pretty spectacularly with the intervention by central bankers to buy government bonds, a thing called quantitative easing. But really, you cannot really pick up a newspaper today without finding some government somewhere in the world that wants to be in the allocation of resources, the allocation of capital, the allocation of your capital, because they don't like the outcomes that the markets are deriving from this. Inequality of wealth would be a clear and obvious one of those. But the idea that they will stand back and simply say, well, just let the markets work it out, is clearly not going to be our future. Think what it means, though. You probably gathered by now that I'm not an economist. I am by training a lawyer and by practice a historian. But if I was trained as an economist, I would be trained that the governments are really a kind of a referee. I'd be trained in one form of economics, neoclassical economics. I'd be told there's supply and there's demand and there's a referee, and then we fight out on the pitch, and then we work out whether supply or demand wins and the price adjusts accordingly. The referee blows the whistle and you've either made money or lost money. There's no relationship to anything in economic history because it assumes that there is a referee. It assumes that the man in the black shirt or the woman in the black shirt is truly impartial and doesn't intervene in the game. There's nothing in financial history, economic history, to suggest that any government would genuinely be that impartial and stand back. Who's the last referee who just stood back? Well, I think the most famous one is a man called Andrew Mellon. He's one of America's richest men who also became the Secretary of the Treasury. And in 1930, according to Hoover in his autobiography, Mellon made the infamous comment as the economy was sliding into recession, depression, liquidate stocks, liquidate capital, liquidate labour. He was the last politician to say that because the consequences were so dire. I mean, the consequences of the Great Depression, for Europe in particular, were incredibly dire. So don't expect the government to be a referee. Now, this is particularly important where we are today. I've already alluded to it. We see every day the government's getting involved somewhere in the allocation of resources. The big picture, which I won't talk about today because it's a 1.5 hour lecture in itself, is a thing called financial repression. So if you want to read any bit of financial history to guide you toward in the next 20 years, I think you need to read the period from 1945 to about 1979, particularly for Europe outside of Switzerland, and look at how resources were allocated using the state, how the state was involved in the banking system, how the state was involved in allocating pension fund money. All of these resources were brought to bear to solve political goals, and that is the world that we now live in. It's not difficult to see what the political goals are. We need to green the economy. We need to build supply chains that are not reliant on China. We are, unfortunately, fighting a hot war, and there may be more to come. And government balance sheets are, tapped out is too strong a word, but the government's already borrowed a lot of money, has huge social obligations in an aging population. Where are they going to get the money from? The answer is easy, from you. That's where they're going to get the money from. There are two ways you can get this money if you're a government. You can get it from the savers, i.e. you can mobilize their savings, or you can print it. Now, we know the consequences of printing it. And if we go back to the Weimar Republic, why did the Germans not just borrow lots of money from their citizens to fund the government in 1923? Because their citizens didn't have any money, because they'd already destroyed it in the First World War. So they had to go to hyperinflation. Now, we don't have to go there because we have all these savings that we can mobilize. So what I see when I see the modern world is I see a government day by day starting to mobilize your savings for public sector good. And if we ever get to the scale of crisis that involves more hot wars, obviously that's exactly what happens. It's called war bond drives. They make it compulsory. And we're slipping into that world. So that couldn't be more different than the last 30 years. Imagine running an asset allocation based on the last 30 years and that happened. I mean, you'd be in all the wrong places at all the wrong times. Financial history, I say this all the time, even when I run the course, it doesn't win me any friends, but financial history may not have the right answers. It has the right questions, though. And at a great structural turning point, you need to ask these questions. Not where are interest rates going next week, not where's inflation going next month, but these questions are the ones you need to ask. Number 6, the ratio of corporate profits to GDP must mean revert in a free society. Now, we have data for this going back, I think, to 1926 for the United States. And if I drew it in the air, it looks mean reverting. Not only that, we can subject it to a statistical test called an Audie-Dickey-Fuller test and discover that it is the most mean reverting series in economic history, or at least one of the most important in economic history. And that's really important. The most important thing you can look at is a mean reverting series because it can tell you something about the future. Now, if only life was that simple. Unfortunately, it can't tell you anything about the future necessarily in the time frame you want that information. This is the problem. But if you have a mean reverting series and you happen to be towards the high end or the low end of the range, it's telling you something about the future. And we've lived through a period where the corporate, particularly the American corporate, has done exceptionally well relative to the interests of other groups in society, whether that be labour or creditors or the taxman. And it's unlikely in a free society that that continues. So we are already seeing quite a few actions, anti-monopoly actions, actions by government trying to break up the power of particularly large companies. And that might now have to accelerate because of the potential power and influence of AI. There is a wonderful book, I don't know if we have it here, Boris, called Goliath. It's a history of the conflict between the United States government and business, which really started in terms of proper legislation in the 1890s, the Interstate Commerce Commission. The government considered that railways were too powerful and brought in legislation to try and stop that, what they obviously thought was an abuse of power. And that, a lot of this legislation is still on the books. It just hasn't been implemented. We have a podcast on the Library of Mistakes called The Myth of Capitalism from Denise Hearn, and you'll hear Denise talk about that. The most active US administration ever in breaking up big business, trying to break up the power of the corporation. If I asked you who it was, you'll probably say it was Roosevelt. No, it was Eisenhower. It was Eisenhower, a Republican, who thought this is a danger to liberty. Not this is a danger to profits, this is a danger to liberty. We need to do something about this. He was a form of Republican who was against big business. And if you think about it, right through US history, there's this rich vein of Americans being against things that are big pharma, big tobacco. You put the word big in front of it and Americans ideologically tend to be against it. Well, we are big. And if you read the Tepper book, Jonathan Tepper and Denise Hearn, or you read Goliath, we've got levels of concentration, corporate concentration, which society probably can't cope with. Now, you can ignore it and just say, well, they'll never do anything about it. They can't do anything about it. Or you can accept the reality that if you live in a world where corporate profits revert as a percentage of GDP, there are lots of ways it can happen. The economy can deliver it, the markets can deliver it, but it may be that the government has to deliver it. So that will be the FTC. The lady who runs the FTC, you probably know, her doctoral thesis, was on how to break up Amazon. So they made her head of the FTC. Number 7. In assessing the appropriateness of monetary policy, assess both the price and quantity of money. I can't think of anything really that's more important than this, because there's a fixation in the financial press particularly that interest rates constitute monetary policy. But interest rates are really like the accelerator in an automobile. But what makes an automobile go is not the accelerator, it's the engine. What you do with interest rates, what you do with that accelerator is you try to change the quantity of money. And by changing the quantity of money, by creating more or creating less, you adjust what you hope will be nominal GDP growth. And if you live in an inflation targeting regime, that's what you're trying to do. But the interest rate itself is not monetary policy. It's a route to monetary policy. And of course, we got this spectacularly wrong from 2009 to 2019. Interest rates were rock bottom. But there was virtually no growth in broad money, so there was no inflation. The people who thought that there would be a great cataclysm on quantitative easing and low rates were wrong, because we simply didn't get growth in broad money, even having low interest rates. Now, what's important there is banks make money, commercial banks make money. There is a little article on the Bank of England website called How Money is Created, and they will say that 80% of all the sterling in the world is created by commercial banks. Well, that's interesting. How many times do you pick up the newspaper to read about monetary policy and they tell you about commercial bank credit growth? Never. I mean, I would say never. And yet it's the only thing, according to the Bank of England, that makes money. Instead, we'll be looking at what are the interest rates, what is the capital adequacy ratio, what are the risk weightings, all these things. And those are the tools to perhaps influence money creation through commercial banks. But it's not money supply. Now, the reason that 45 to 79 period is so important is that there was another way of controlling this in that period. And it wasn't through interest rates. Interest rates were not used to control the supply of money. Governments control the supply of money by telling the banks how much to lend. If you were all the bankers and I was the government and I brought you in the room and said, each one of you will have growth over the next 12 months in your credit of 10%, then we know we're going to have roughly 10% growth in the money supply. Go away, come back next year. It wasn't based on interest rates. It was based on the government because the government needed to steer that credit as well. There were places it needed it to go. It couldn't allow bankers to be involved in this. It was too important. We were rebuilding the whole of Europe. We didn't want anybody running private equity, speculating in property. We wanted to rebuild. That's where we are today. We need massive investment. And this massive investment will be financed by our banks and our bond markets and commercial paper markets and note markets, but by our banks. And it will be directed by the government to where it needs to be. And it will not be allocated by the price of money. You know, in the great gearing boom that we've seen in America, which really began in the early 1980s, you know, even dogs got credit. I mean, dogs would be mailed credit cards through the post. That era is over. This is a new era where the state is more involved in directing credit, and they'll create too much, and they'll create too much money, and they'll create too much inflation. So we've only got to number 8, so this is going to be a long evening. The most dangerous form of speculation is the search for yield. And then I have a quote from Walter Bagehot. John Bull can stand many things, but he cannot stand 2%. Now, this is simply to say that with your savings, you won't accept a 2% annual return. Nobody will accept it. Virtually nobody will accept it. I mean, you had to work hard to get the money. Then they took a huge chunk in tax. Then you had to sacrifice spending. Then you got this little bit at the end, and they said you can have 2% on it. Well, people don't accept it, and they go out looking for higher returns. And that's the world we've just lived in. So people are going out looking for much higher returns, and then they take much higher risk. It doesn't feel like they're taking much higher risk, but they are taking much higher risk. And of course, interest rates have now gone up, and somewhere out in the world, somewhere, someone has taken far too high a risk in pursuit of the yield and will pay a price for that. What is the number that we deserve, do you think? I think it's the answer to that is not actually in financial history. I think it's in literature. If you read a lot of literature where you have people talking about their finances and the history of their finances, and Jane Austen in particular, Jane Austen was very keen to find a man with lots of government bonds yielding 5%. So if you want a lady, you need 5%. There's this number that keeps cropping up, 5%. I think it's kind of hardwired into us to believe that after all the sacrifices we make to have savings, we want 5, so we'll get 5. Now, I did this presentation to a book festival in Ayrshire, and afterwards a man came up to me, and he had been in a defined benefit pension scheme. You probably know that when interest rates got very low, you could cash these in for very large sums of money. He got a very large sum of money. Everybody else that he worked with got a large sum of money. And he came up to me, and interest rates were very low. And he came up and said, I just want to tell you this. All my friends who cashed in their defined benefit pension schemes, they all own Portuguese vineyards. Why? Well, they yield 5%. And we're only getting 1% in the bank. Now, maybe that worked out well for them. I really hope and pray that it worked out well for them. But they would never in their wildest dreams have contemplated investing, putting all their money into a Portuguese vineyard, had interest rates been at 5%. So we must remember there's always someone taking a risk somewhere. The lower rates go, the more of a risk they're taking. Number 9 may be quite topical. The real danger for investors from populism depends on the strength of the Constitution and the rule of law. Well, we're about to have an election in the United States of America, which could conceivably test the Constitution. Wherever you are in the world, you have to have a view on this. I mean, I've witnessed in my life the opening of stock markets. You know, when I started in this business in '89, there were lots of countries that didn't have stock markets because they closed them all. usually at the end of World War II, usually because of communism. They reopened them again. But the question is, should they have stock markets? I mean, if you don't have a rule of law, remember what you're buying when you buy that little bit of paper we call a share. You're buying a right to an asset and a right to a cash flow. But the right's meaningless unless you have a rule of law. So this is probably because I'm an ex-lawyer, but I put undue store by this. I've never invested any money in China. I never invested any money in Russia. I didn't ultimately think that I owned these assets at all. Now that could still be proven wrong, but I think it's the most important thing, the bedrock of what we do. So when you're trying to find and invest today, given the upheavals that are coming, given the changes in constitutions that are likely in this world, first and foremost, find somewhere where you believe in the rule of law, because you can lose everything and you can lose the lot if that goes. Now, my own personal view is an American Constitution is exceptionally strong, and regardless who comes along, the Constitution will win and the president will lose. And I'll come back next year and talk about that again, Boris, and we'll see what's going on. Number 10. This is taken from a book by Reinhardt and Rogoff, which will be in here as well. This time is different, looking at the history of default. And I think there's a very interesting line in there. The countries most likely to default on their debt are those who have defaulted on their debt. So the past is a guide to the future. Remember, all available information is in the price and tells you nothing. No, when it comes to debt, people who default on their debts tend to keep defaulting on their debts. It's just like friends. It's like friends who don't pay you back. Do you lend to them a second time? This is what happens. Now, there may be many reasons for this, and I think it's to do with the institutions. But ultimately, a lot of these debts are money lent by foreigners. The history of emerging markets in particular is foreigners lending money to emerging markets. And then as a politician, you've got a choice. Do I force my people through a kind of grinding deflation to run a huge current account surplus, to generate all the foreign currency to pay the foreigners back, or do I get elected? And that's the way it goes. So most people, because they tend to borrow foreign, default on their debts because the consequences of paying it back are so dire for the local people that they don't contemplate paying it back. I first put that down just as Argentina was launching its new 100-year bond. You're going to ask me the names of the nine countries now. We'll look that up later. But certainly the surprising thing is they're not all in Latin America. You might think they're all in Latin America, but certainly Egypt is one and Greece, Turkey is one as well. Greece also has a very bad reputation for defaulting on its debt. We tend to think that this is a Latin American problem, but actually there are serial defaulters not too far away from where we are today. Number 11, well, I really run a whole course on this, so we'll be quick. High equity valuations fall slowly when their surprise is inflation and quickly when it's deflation. So there are two periods in US history where we get a very long decline in US equity valuations, 1901 to 1921, 1966 to 1982. It takes that long to go from the peak valuation to the low. Now that didn't happen from 1929 to 32. It was all done very, very quickly. Well, those long bear markets in equities where the valuation 66 to 82, where you lost a lot of money, particularly in real terms. The surprise, you can always look back with the benefit of hindsight and say, what was the surprise? Well, the surprise was inflation. Not that inflation was a bit higher, that inflation was so much higher that interest rates went to levels never recorded before in US history. Outside perhaps the Civil War, if you happen to live south of the Mason-Dixon line. And that brings equity valuations down much more slowly than economic collapse. Because economic collapse threatens the solvency of corporations instantly. Inflation takes a longer time to threaten the solvency of corporations. And that's why it's a long, slow decline. So I mentioned earlier, US equity valuations are very high. Instinctively, as soon as I say that, you've got a mental image of a share price chart going like this. It's just hardwired into us that something is very expensive will fall very quickly. Not true. It doesn't have to fall very quickly. The future for that particular market could be a world where the index, in a volatile fashion, goes sideways for many years, but corporate earnings grow very strongly, particularly in nominal terms. That's what happened from 66 to 82. Now you might say, well, I don't really care. I'm going to lose money in them anyway. Well, you are going to lose money in them anyway, but you should care because there may be other things out there which you can make money in. If the US stock market's going to fall 70%, it's difficult to conceive that things are going to be going well in the UK or the Japanese market or anywhere else in that type of collapse. And that type of collapse will breed solvency issues for the financial system. We saw it. We saw it from 2007 to 2009. But this doesn't. I mean, it may end up with some significant solvency issues for the financial system, but it doesn't. And therefore, this is a much better background to be an investor, to seek positive real returns than the great collapse. Cyclically adjusted PE today, 34 times for the US. The lows are usually under 10. Now, if we're going to be there by next Christmas, I'm afraid there's not much you can do about that to make any money. But if it's going to take us 25 years to get there, there's plenty of things you can do to be making money. So consider what the future holds. Is it hold deflation or inflation? If it holds inflation, I think equities are where you want to be, not the S&P 500, but there are stock markets all around the world on relatively low valuations that would do relatively well. And in that period, that prolonged period from 1966 to 82, value stocks did okay. I mean, not brilliantly, but they produced positive real returns because they started cheaply. They had a low valuation. They couldn't really come down any further, not much further anyway. Number 12, never buy in emerging market equities if the exchange rate is overvalued. I can talk a long time about exchange rates, and particularly maybe we should talk about it in relation to China. When a country decides to target its exchange rate and it is overvalued, there are more sellers than buyers of that currency. And that forces them to buy back that currency. That is how you defend it. Or raise interest rates to defend it. So in other words, it forces you to run a tighter monetary policy. And there is a link between liquidity and the stock market. I said there isn't a link between GDP and the stock market, but there certainly is between liquidity and the stock market. And if you were running a very undervalued exchange rate, you'd run a huge surplus, and they'd actually print and create a lot of money. That would tend to be good for the equity market. And the history of emerging markets who run these policies is that the valuations of the equities themselves get totally disconnected from anything to do with reality. So by the end of 1989, the Taiwanese stock market, I think, was on 65 times earnings. The Hang Seng Index got below 10 times earnings in 1998, all because of the focus on managing the exchange rate and just letting all the other monetary variables find their own level. So if you're going to go investing in emerging markets, but anybody who manages their exchange rate, keep an eye on the exchange rate. I mean, it looks really like the Chinese exchange rate is overvalued. It's a country that runs a small current account surplus relative to GDP, but it's now running a profoundly negative capital account deficit, suggesting that whatever competitiveness it may have on the exports of goods and services, it doesn't seem to be that competitive on the choice of where people want to allocate their capital. And that's crucial to remember. Most economists will tell you that you work out the undervaluation of a exchange rate by looking at a PPP calculation, purchasing power parity calculation, but it's really based upon differential prices in tradable goods. The world we live in, the external accounts are dominated by capital flows, not the flow of goods and services. And you have to come to some conclusion about whether we're competitive on that. And at the minute, China is repelling capital at a ferocious rate. In fact, at a rate that I've never seen before for a major economy, because its foreign direct investment inflow is a negative number. How can an inflow be a negative number? Foreigners are selling more direct investments in China faster than they're adding them. And as I say, I've not actually seen that before, certainly for any major economy. My view, Chinese exchange rate is overvalued. That's why they're heading into a deflation. Their monetary policy is too tight. But at some stage, they'll have to do something about that. Number 13, tourism is the best guide to whether an exchange rate is overvalued or undervalued. Always visit the Rockefeller Center at Christmas. So this is obviously slightly tongue-in-cheek, but it's important. When I went to Asia in the early 1990s, into the mid-1990s, I thought there was going to be a crisis. I was almost alone in that. Foreign money was pouring in to all these markets: Malaysia, Thailand, Indonesia, the Philippines, Hong Kong. But what was local money doing? It was going the other way. It was coming out. Malaysian corporations were buying kind of just about any foreign asset they could get their hands on. They couldn't believe their luck. The exchange rate was overvalued. Their paper was grossly overvalued. They could issue Malaysian paper. They could buy all the lovely little assets they wanted to own, including Swiss hotels. It was all falling into the hands of Malaysian ownership. And you could sit in front of a firm and say, just don't you think you should ask why the locals don't want to own the assets that you're buying? But they would say, well, they're stupid. They don't have a degree in finance. They really don't understand economics whatsoever. You know, they've never even heard of return on equity. These guys, they don't know anything at all. Well, that happens a lot. Now, if you find yourself in a country where that's happening, the locals are right and the foreigners are wrong. Now, this thing about tourism is one way you can do that. So when I go to the Rockefeller Center, all I do is I stand there. It's a beautiful place to be at Christmas, but it's a very expensive place to be at Christmas because hotel rates are through the roof. And you listen to see what language people are talking, and then you short the currency. It's a good indication of an overvalued exchange rate. I mean, anybody who could afford to be at the Rockefeller Center from Russia, Brazil, France, Italy, maybe it's telling you something about their exchange rate. So, I mean, I haven't been for a while, obviously, because of COVID, but it was all, I mean, when I go, it's French and Italian that I hear at the Rockefeller Center these days. I'll let you draw your own conclusions. But anyway, that's slightly tongue-in-cheek, but the point is, look what real people are doing with their own money. We live in a world, Boris and I live in a world full of agents. Agents are different. That's other people's money. It was Adam Smith who warned us about agents. Adam Smith was not a favour of the joint stock company, by the way. He said it was very dangerous because it was agents running other people's money. Well, the whole world's now agents running other people's money. If you get a chance between looking at the decision of an agent and a principal, always check what the principal is doing because it's their money and they tend to make better decisions. I think that's true for the average guy in the street in Beijing, Buenos Aires, New York, Lausanne. They're ultimately going to be better at making those decisions. Or at least they're going to give you important information that you're not getting by following agents. Number 14, always buy equities below 10 times CAPE, unless the future holds communism, war, or surrender of monetary independence with an overvalued exchange rate. So if price is what you pay and value is what you get, sometimes they're just so cheap that you buy them and you go away, and you know it's going to be okay. And throughout history, it is okay, except basically on these three occasions. You can lose everything. You can have it confiscated. You can be destroyed by enemy bombing. And the third one's important. So if this thing about always buy equities below 10 times CAPE, walk away, well, I could have said that of Greece. The problem is I could have said it in early 2008. Well, didn't make any difference. Basically, lots of companies went bust, few survived, and I think many of them would still be below their price of thin because they didn't have an independent monetary policy. They didn't have a central banker who could just say, you know what, this deflation is going to destroy everybody, let's just print money. Now, there are downsides to that. We all know the downsides to that, but ultimately it can save corporations that are going to go bust, and Greece didn't have that, so it went down. So when you look at any society locked inside somebody else's monetary regime, you have to be particularly careful. And I think there are problems with that in Europe. There's a lecture here. It's got 22,000 people have watched it on the fragilities this is bringing to Europe. And maybe you could have a look at that. But to cut a long story short, I think the problem is France. It's not Italy. Number 15. Democracy is more suited to the operation of capital controls than the free movement of capital. That's obviously very controversial. Most of my life, we've had the free movement of capital. But democracy is a kind of new thing. Certainly in the United Kingdom, we didn't have democracy until women without property got the vote. That's 1928. 1928 before we have democracy. And then you have a situation where the people vote for the government and the government tries to do what the people want and capital arbitrages. It leaves. And it goes and negotiates with the governments over here. It said, well, this guy's going to be what I want. He's not going to be what I'm just going to move. In other words, there is a leverage that capital has against any form of government, but democracy and a free movement of capital. We assume it's perfectly normal. But as I said earlier, governments accept and endorse these things if they deliver what they want. But if they don't deliver what they want, why do we think they'll live with this one, which gives such power to capital and savers to, I'm going to use the word exploit. We'll use arbitrage. It's a much better phrase. Arbitrage labour markets, arbitrage governments, arbitrage tax systems. And it's happening. The base erosion profit sharing, one of the most boring pieces of legislation you've ever heard, but is really crucially important. The OECD, BEPS, base erosion profit sharing, is the beginning of governments beginning to fight back on this, to beginning to say you can't arbitrage your tax away. You can't move capital here. You can't borrow money over there. And that is beginning to come back. If what I said earlier is correct, and the government ultimately ends up forcing people to own its own government bonds, that is a way to keep interest rates low. Well, that is a capital control. Not in the old sense of the word that, one would have been searched just coming over the border from France to see whether they had any money in their pocket. but in a different way, by restricting the amount of debt that you can own outside of Switzerland or outside of France or outside of Germany. That is a form of restriction on the free movement of capital. And that, I think, is coming back. Because in the world that we're talking about, this new political world, the governments can't live with capital arbitraging them. Now, you all know that one of the reasons that Switzerland is so prosperous is because you didn't do this. And money flooded in here after World War II. And there are lots of places around the world where that has happened. But I think we may be going back to that. Doesn't mean to say the money comes to Switzerland. Personally, I think it'll go to Singapore. But so we have to remember we may not be playing chess in 3 dimensions anymore. It's conceivable that, like our fathers or grandfathers, we may be back to playing in 2 dimensions. Now, number 16, I think we can skip past quite quickly because I've kind of covered it. There is concern about governments inflating, massively inflating away their debts, but they don't have to because they have your savings instead. They don't need to print money to fund the green initiative because they can get you to fund it instead. So I don't worry about in terms of the way we live now, I do not worry about hyperinflation in the developed world. I worry about financial repression, about managing your savings for political goods, but not hyperinflation. And that's important because the assets you would own in a hyperinflation are very niche, very small, and I don't think, and they wouldn't be equities. So because it's not going to be hyperinflation, I think we can still consider well-valued equities, and there are plenty of them in the world, if not in the main indices, to be something that you can invest in. So savings will be conscripted, but not inflated away. Not inflated away quickly. Number 17, technology never ultimately defeats inflation. This is one that is not as contentious as it used to be. But when I used to say that inflation was coming back, one of the main things would be, but Jeff Bezos won't let it. Jeff will never let inflation return. We've got all this technological innovation going on and prices will come down forever. And you can't talk about higher inflation. The obvious answer to that is we've had quite a lot of technical innovation since 1900, but prices are, I don't know what they are, 850% higher, probably even more than that. So we have lived through a period of technological marvel, and yet we've lived through a period of very high inflation. Inflation is everywhere and at all times a monetary phenomenon. And the idea that many people had, that technological breakthrough would structurally depress inflation and we would never see it coming back again is just simply wrong. A government or a central bank in control of a printing press can generate as much inflation as it wants to, and they have to try to bring down our debt to GDP ratio. We need high nominal GDP growth if we're going to bring down this debt to GDP. It's a political target, and those who think that inflation will stop it, I think are just straightforward wrong. Number 18, we're nearly there. Monetary systems fail about every 30 years. Do you see much in the Financial Times or the Wall Street Journal about failing monetary systems? I see a lot about whether interest rates are going up or going down, but not whether monetary systems are stable, unstable, failing or not failing. So let me tell you the monetary systems I think are about to fail. I don't think China's going to peg its currency to the dollar. You will have already gathered that. I don't think the euro is sustainable. You'll have heard that debate many times before. There's been a lecture here on that. I think Japan will have to start repatriating capital to fund its government. It'll have to start selling overseas portfolio assets and bringing it back to buy its government debt. That's enough, really, isn't it? That's, these are the second, third, and fourth biggest economies in the world just there. And maybe we question the reserve currency status of the dollar. I personally don't, but maybe that's another issue. These are the biggest and most profound things that could happen. Just one of them would be big and profound. But we're living through a failure of all of them. A failure is a dramatic word. A change might be better. But how can you manage your wealth or somebody else's wealth and not consider the structural implications from these changes? And that is what I try to do for my clients. And the old system leaves imbalances. When these old monetary systems end, they have left something enshrined in the form of an imbalance. In our case, far, far too much debt in the private sector and the public sector. That's the imbalance generated by the old system. And you have to work out what the consequences are when the old system ends. I think the overvaluation of equities, US equities, are also part of that. Number 19, money is almost always in disequilibrium. At least I hope it's always in disequilibrium, or else how are we going to make any money? Never ever believe in an equilibrium model. Everything reaches equilibrium once every 25 years, right? But that's not what the business that we're in here. you should be interested in disequilibriums, because that's where you can make money. Now, I think the biggest disequilibriums come when the state tries to fix the price of something. Private capital arbitrages it, imbalances build up, money is made, money is lost. Managed exchange rates are the best example. These are where you're going to get massive disequilibrium. So I'm just saying to boss, I've written a new report focusing on emerging markets. I think they're going to actually have emerging markets ex-China, very large external surpluses. They're going to have to prevent their currencies going to go up. They're going to have too much money. They're going to be a massive disequilibrium in emerging markets. And that is one of the consequences from the change in the monetary system we got. I mean, we've been putting, 3 years ago, 20% of all the foreign direct investment in the world went to China. It's negative now. Where's it going? You can make a lot of money just knowing where it's going. I think it's going to emerging markets. I can show you the data comes with a lag, but it seems to be going to other emerging markets. That is where it's likely. If exchange rates are not allowed to rise as that foreign capital comes in, this is where the disequilibrium is likely to come. Number 20, never trust a forecast with a decimal point. I think we started with Angus Deaton. Maybe we're getting close to ending with Angus Deaton. I think Angus agrees. I think that's the whole point of what he's just said, that the tyranny of the decimal point was allowed to get in the way of understanding, our understanding of how things actually work. And the problem with that decimal point is it shows a degree of confidence in the future, which is overconfidence. Nobody can be confident enough to put a decimal point in forecasting the future. It's difficult enough to get the direction, never mind the quantum. And when you see someone who's using and wielding the decimal point, remember what they're actually doing. They're trying to sell you something, and what they're trying to sell is their intelligence and precision. Now, if we had another analyst up here who dealt in the decimal point, and I started telling you stories, because really all I've been telling you all night is stories. Stories based upon the past, but stories nonetheless. But what happens if there was a man here, or a woman here, who could wield a decimal point and could show you some equations and then say, and the future is 4.6521 recurring. You go, wow, I'm going with this woman over here. She really knows what she's talking about because she's precise and this guy's only got stories. But she's only got stories told through a decimal point. And it's the precision of the story which is dangerous. All our stories, I've tried to give you a range of stories. We're just trying to work out the probabilities, the future likelihoods, and position assets and savings based on the fan of outcomes, not on the decimal point and where it's absolutely going to be. Remember Mussolini. Why was Mussolini famous? He made the trains run on time. What he did is he walked into a world full of uncertainty and promised certainty and delivered it. That's what happens in finance. We live in uncertain times. We live in particularly uncertain times. The person who's going to sell is the person who walks into the room and say, you know, all this uncertainty, I have an answer to 2 decimal places. Nobody has an answer to 2 decimal places or 1 decimal place or even with a decimal point. So beware of that. And the most dangerous decimal point is the one you put in your own forecast. Because now you're fooling yourself. It's bad enough that somebody else is fooling you. You can cope with that. There are ways we can cope with being missold, but not with misselling yourself. So beware that. Now, 21 is a misquote from Karl Marx. No presentation on the history of finance is complete without mentioning Karl Marx. And Marx infamously said that religion is the opiate of the people. But of course, extrapolation is the opiate of the people. Straight line extrapolation is the opiate of people. That's the certainty we all have. We extrapolate the past into the future. Now, I'm here to tell you about financial history. You would think, well, this guy's going to be a big fan of extrapolating the past into the future, but I'm not. What this has been about is the mechanisms that operate and how by reading and understanding financial history, you can better understand mechanisms. And that's it. If you understand those mechanisms, if you understand some of the consequences in the past of the operation of those mechanisms, it increases your probability that you'll be right about the future. But it's not extrapolation. Extrapolation is dangerous. It's the opiate of the people. And at this time of great structural change, we need to be thinking differently. And the most dangerous thing you can do is take anything really from the last 30 years, not the last 30 weeks, 30 months, but really the last 30 years and say, that's a good guide to the future because it's now a dangerous guide to the future. So that, I think, and I hope, is some ways in which, based on Mr. Deaton's assertion, that a historian can give you something about at least the parameters through which you should be seeing the future for the economy and the future for financial returns. And at that stage, I welcome any questions. And a glass of water.